Okay. All right. So that's the take. But let me take it across. We have Mr. Debadatta Chand, who is a CEO and Managing Director at Bank of Baroda, joining us this morning. Sir, last quarter, Mr. Chand, you had indicated that asset repricing would gradually offset sticky deposit cost. Q1 margins are actually lower, so you're continuing to see pressure. What's the outlook going forward?
As far as the margin is concerned, we continue to have the guidance of 2.75 to 2.95. If you look at the June quarter vis-a-vis the last quarter, the NIA growth has been very strong at 9.5%, whereas the asset growth has been higher than 9.5%, putting pressure on margin obviously for the factor. But currently, two trends that we are looking into the market, particularly bit of a corporate non-MCLR linked book, we are looking at a repricing of those. It's happening also. At the same time, post the announcement of the FCNR B measures, the wholesale market has also cooled off. So considering both the factors, I think the margin guidance of 2.75 to 2.95 will be in a position to be in those guidance.
Right. Excluding the exceptional overseas provision, Mr. Chand, the underlying profitability remains healthy for you. Is it fair to assume that the bank can sustainably deliver 1.1% plus ROA through the cycle?
Look, we have been last 16, 17 quarters having a ROA in excess of 1. And this quarter, because of the exceptional item, it is below 1. While we are hopeful that Q2, Q3, Q4, the ROA is going to be more than 1. But on a full year basis, because of this impact, obviously the ROA is under watch by us. Any revised guidance, I said, will be announcing post the Q2. Because couple of one side also, one of upside also we are looking at. Once those things should crystallize, possibly we'll be in a better position to articulate the ROA guidance. But we are hopeful that quarter to quarter from now onwards, we'll be in a position to achieve ROA more than 1, but a full year will give a guidance at a later date.
And you had earlier indicated that the final ECL impact would likely be lower than the initial estimates. Now that calculations are more advanced, you've guided for around 110 bits, but give us a sense on impact from a timeline and from a CT1 perspective. Just give us a sense.
So to impact here now, I mean, the guidelines has been issued. The bank is preparing itself both in terms of technology, application, and the migration. On the estimate as on today, in terms of the actual calculation, we expect the impact on the CRAR would be almost like 110 BPS, which can be spread over. But again, to remind you that we are also holding a floating provision of 2,500 crore, which can be well adjusted against that. At the same time, on the credit cost side, we are expecting the impact to be 15 to 20 BPS. If you look at as on today, my credit cost is 0.29 as on June. And we have given a guidance of 0.6. So I think within the scope of 0.6, the credit cost can be absorbed therein. So the bank's capital adequacy is quite comfortable. The CET1 as on today is 13.9. So even if you factored in the amortizing the one-time impact, netting of the floating provision, it can be, I mean, year to year, the CRAR impact can be 20 to 22 BPS, which currently the capital is quite adequate. Notwithstanding that, we also articulated for raising capital in medium-term outlook, where we almost intend to raise 8,500 crore of equity by March 2028, and also buffer up in terms of a 6,000 crore the tier 2 instrument. So I think the bank is well capitalized. The ECL migration is going to be smooth, and the bank should have sufficient capital for growth in the future.
Your core fee income was weaker this quarter despite healthy business growth. Was this largely timing related, or does it reflect a structural change in the business mix? And when should we expect normalization?
It's not timing, it is more market related, I would put in that way, because the June 2025, the treasury income was significant. Like the income was, I believe, in excess of 2,200 crore. Whereas treasury income in this quarter is only roughly around 800 crore. One reason precisely in June 2025 quarter, the yield was, all-time low at 6.13 at that time. And now the yields are elevated at this stage. So it's more of a market linked in that way. But obviously, one element we'll try to optimize is the fee income in terms of commission exchange brokerage. I think going by that, I think if the market supports, we'll be in a position to normalize that. One element you would have seen on the fee, I mean, the non-interest income is a PSLC sale of 270 crore as a line item, which was not there in the earlier quarter. I think there also we have scope for further earning income of that. The recovery out of TWO is also, I think it's better than the last quarter. In that way, we're trying to optimize the entire piece of non-interest income. And going forward, we'll be in a position to maintain or grow on that count.
And how is the traction for FCNRB deposits? You also increased overseas borrowing limits to $10 billion. How do you see the optimal funding mix between FCNRB deposits and wholesale overseas borrowings over the next few quarters?
So on two accounts, you said one is with regard to FCNRB. As on today, I think we have almost like 650 to 700 million we have raised now. FCNR, we expect till September will be almost crossing 2 billion that way. Our overseas borrowing in terms of both ECB, the bond issuance or the OFCB, I mean, already we are looking at 1 billion each for the time being. But then we upsize the amount that we can raise on these two counts precisely because I am growing also on the international book. So I would raise either a bond or a OFCB higher than the 1 billion each we are talking about as far as this current window is concerned for funding my overseas growth also. So it's a combination of money that we can bring it to India through the swap route and also using the funds for overseas expansion. So for that reason, actually, we increase our limit from 5 billion to 10 billion.
Right. And your corporate advances, they moderated sequentially despite a healthy overall credit growth. What led to that, and how is it that you're targeting the loan mix going forward? And what then will be your growth guidance for the full year?
So if you look at my overall advance growth, it is 17.4%, which is one of the strong growth as far as the system is concerned. Within the advance growth, we have grown strongly on agri, MSME, and retail, which is almost 18 to 20%. The corporate growth this time is 15.4%. Sequentially, there is a decline therein. The decline is precisely its seasonal. Secondly, decline is typically the non-MCLR linked corporate book will slightly realign those book in terms of slightly repricing it higher. So that is one reason why sequentially we have seen a lower book. But on a full year, we are keeping the guidance as it is at 12 to 14%. But we will always try to, outperform our guidance on the matter. Well, looking at two overhang as on today, as far as the economy is concerned, both on the geopolitical and the monsoon tracking. So although we have outperformed significantly, but then possibly we'll be in a better position to articulate on the guidance post our second quarter results.
And CASA continues to remain under pressure across the industry. Where do you see your sustainable CASA ratio over the medium term, and what initiatives will help you get there?
I think this is one of the success story for Bank of Baroda in terms of both saving and CASA. If you look at these two parameters, we've been consistently able to grow beyond the system. I mean, I'm talking about the medium of the system by 1 to 2%. If you look at the CASA growth as on June also, it is almost 10%, and the saving is also in excess of 9%. And these are number strong growth. Actually, we have targeted on the CASA low-cost deposit since last many years. And the target was typically in terms of aligning our product processes, in terms of bundling our products, in terms of slightly, the brand ambassador also played a role therein. I think this is one of the key area or a strategic priority for the bank to grow on the low-cost deposit. So in terms of the earlier growth, definitely the CASA growth for the system as a whole is low, precisely for the reason that possibly the consumers or the savers have other alternative areas to deploy their funds. But we as a bank quite, significantly working on the piece of low-cost deposit and could outperform to the market by some extent. And that would continue to be our priority area. And I think on the product process and the service delivery will be improving so as to get more CASA.
Right. Great to then have you on the show. Thank you so much for your time, and thanks for highlighting what exactly the earnings performance, Mr. Chand, is going to look like even going forward. That's BOB.